Hello, S- welcome to the September-December 2020 AFM paper question 1. I was left with question 1 only. So with this video, I will finish the 2020 paper, September-December paper. I have uploaded question 2 and 3. Please go and check them. And this is question 1. So as you can see, you have been given some bonds, the ratings. It shows that you have to do some bond, right? So let's start. Part 8. Discuss the feasibility and the effectiveness of the different strategies of selling of individual garden centers and enhancing directors' remuneration. This is a theory question. You have to discuss the feasibility and the effectiveness of selling and enhancing directors' remuneration. 7 marks. Coming to part B. Okay. Part B. Prepare a report for the board of directors of Kingdom, so these are the 5 things you have to do. And it has to be done in this order. Estimate the company's cost of capital before the new bonds are issued. Cost of capital before new bond. Second, estimate. See, this word estimate should tell you this. All these are calculations. Except this. The last one is discussion. It can go to your report. Okay. So estimate the market value and the yield to maturity of the new bond. You should know the valuation of the bond. This also can come as a 50-mark question. Third, estimate the revised cost of equity. Revised cost of equity and revised cost of capital if new bonds are issued. And fourth, estimate the impact of the chief executive's proposal on forecast after-tax earnings for the coming year. Chief executive's proposal on after-tax earnings, the impact. That means before and after. It's just for 3 marks. Next, discuss. If you see the discuss, it is having the highest mark, 10 mark. So you cannot underestimate the power of writing over numerical questions. Discuss the impact on Kingdom's cost of capital and the reaction of equity and bondholders to the chief executive's proposal. Here you have to talk about cost of capital, reaction of equity and bondholders to the proposal of chief executive, right? And the discussion should include an explanation of any assumptions made in the estimates from first to fourth one. So assumptions, keyword. Part C, discuss the approach taken to employee remuneration by the Kingdom's northern region and the issues associated with it. Clearly see there are 2 requirements in this. One is approach taken for employee remuneration. The other one is issues associated with this. So this, I'm first going to start with part B. I'm going to cover the part B, the report part, and then we'll go for A to C. So first we have to estimate the cost of capital. We have to read the case study. Kingdom is a nationwide chain of garden centers selling products such as plants, fertilizers, tools, and garden furniture. It was established 20 years ago by the current team of executive directors and achieved a listing on its local stock exchange 4 years ago. Since listing, the company has made consistent profits and has been able to increase its dividends each year. The executive directors collectively own between them 25% of issued share capital. The remaining shares are held by a number of investors, with none of them owning more than 10% of issued share capital. 2 of the Kingdom's major competitors have been taken over in the last 2 years. Media coverage suggests that further takeovers are possible. Potential acquirers include other chains of garden centers, property developers, and supermarket chains looking to diversify their investments into profitable garden center sector. As yet, no potential acquirers approached Kingdom to buy the whole chain, although Kingdom has had inquiries from other businesses wanting to purchase individual garden centers. Kingdom can sell a number of individual garden centers without threatening its continued existence. So they are more worried about the international garden centers. Now takeover defenses. Kingdom's executive director remain committed to the business. They are fearful of a takeover, believing that the new owners will want some or all of them to leave the company. They have therefore been considering possible defenses against takeover bid. Kingdom's chief executive has received 2 proposals from directors. What are the 2 proposals? Number 1, sell the individual garden centers, which would be particularly attractive to purchasers. Disposal of the centers would make Kingdom overall a less attractive purchase. Right? So if they are saying this is one of the way to defend against takeover is to sell your individual garden center, so Kingdom then becomes less attractive for a takeover. Next proposal is pay the executive director higher remuneration. Okay, and change their contract so that they would receive much higher compensation for the loss of office if their contracts were terminated early. There are some keywords for this, for the first and the second one. Make sure that you know the keywords. Okay, the first one, selling assets. Selling individual garden center means you are selling your valuable asset. It is known as crown jewel, if you have heard this word. And the next one is what? Telling them to give higher remuneration and all. What is the word? I'm not going to tell. Okay, we'll discover it. So Kingdom's chief executive believes, however, that any defense Kingdom adopt should also strengthen the company's future. She is therefore proposing to expand the company's current limited sales of camping products in its garden centers by establishing a chain of Kingdom outdoor shops selling campe, walking, and other outdoor equipment. The outdoor retail sector is competitive, but the chief executive believes that Kingdom will be successful. The establishment of the chain of the outdoor shops would be funded sold by debt. Okay, will be sold by debt. The idea being that changing Kingdom's finance structure by having significant more debt would make it less attractive to acquirers. Yes, so they're saying if you're having more debt, it makes you less attractive. Financial details are given to you. What are the financial details? The Kingdoms currently has 25 million $1 shares in issue with the current share price. If you see by now, it is always given like this, your share price and your share, to find the market value of equity. Okay, so here I can write market value of equity. This is how I am annotating. So I know when I have to quickly find out the market value of equity, I can come here and find out. It also has 0.45 million 6.5% bond issue. Each 6.5 bond has a nominal value of 100 and is currently trading at this one. Okay, so 0.5. This is talking about for the market value of what? Market value of debt. The premium on redemption of the bond in 3 years time is 2%. There's a premium on the redemption in 3 years time is 2%. Based on the yield to maturity approach, the after-tax cost of the after-tax cost of this one is 4.5% based on yield to maturity. That is the cost of debt. They are saying after-tax cost of bond means what? Cost of debt, because you already have bonds in your debt. Kingdom's quoted equity beta for its existing garden center business is this one. Their equity beta for garden is 0.9. Because why this equity beta is given? To find your cost of capital, cost of equity. That's why this equity beta, asset beta is given. Okay, so Kingdom's plan to issue how much? 0.6 million 7.5% new bonds. When you need for your new valuation for the new bond, when you have to find the cost of capital, you need this piece of information from here. 0.6 7.5 new bond with each a nominal value of 100. These bonds will be redeemable in 4 years time at a premium of 8%. Before it was 2%, now it is 8%. The coupon on this bond will be payable on an annual basis. Okay, we don't know the coupon. These bonds are anticipated to have a credit rating. So this bonds, this is the credit rating, triple B minus, and the issue of, and also you'll be given the basis point for that later down. And the issue of the new 7.5% bonds will not affect the market value of Kingdom share on the existing 6.5%. Okay, so don't worry about it. They are saying because you are issuing this new bond of 7.5, it will not affect the market value of the Kingdom's share. So the market value of equity remains the same. That's what it means. Okay. Market value of equity same before and after that new bond. Now the market value of the new bond will be determined by using information related to Kingdom's credit rating and 4 bonds where the government has issued to Kingdom. Okay, all these bonds are the same risk class data of bonds. So you have been given the annual rate and you have been given the redeemable. You have to use it. Okay. And also the credit spread has been given. You have to pick which one is appropriate for which year based on the redeemable date, redemption date. Now, Kingdom plans to invest 60 million in non-current assets for outdoor shops. Working capital requirements can be ignored. Okay, it can be ignored. So current Kingdom's non-current assets have a net book value of this one. They are not current assets and net book value is this much. It is assumed that the proportion of the book value of non-current assets which will be invested in the outdoor shops and the garden centers will give a fair representation of the size of each business unit which they present. This type of question has been given somewhere. if you can recall your memory. You have done this type of question where you have to use the size of the non-current assets to say what proportion is for garden, what proportion for the outdoor shops. Okay, it depends on what book value of non-current asset. So the asset beta of the similar companies in the outdoor is this, what similar company in the outdoor is 0.88. You need that asset beta for proxy company to find the asset beta for your company. Then you find the equity beta, then you find the cost of equity, and then cost of capital. So before taking into consideration the impact of this new investment, they are focused before this new investment. Their forecast pre-tax earnings is this much. You have to show the impact also on this. It is an estimated that the new investment will take a so the new investment will take this pre-tax return. You have to adjust for tax. Remember, the tax is 25% and the current risk-free rate is this, and risk premium is 9%. Employees remuneration. Now you can make a choice. You can read it or late, or you can read it when you are answering part C. Okay, because for part C you need to work with that remuneration part. And also, so that does not apply in part A. If you see here also you are seeing remuneration, but this is your director's remuneration, not employee. This last para is for employee remuneration. Okay, so but we'll finish reading it. Kingdom's annual report contains a general commitment to act with social responsibility in line with society's expectations. It also commits to paying its staff fairly in accordance with their responsibilities and state that its staff are vital to its success. So they are giving the importance to their staff, saying it's very important, they pay fair and all. To try to improve the situation of low-paid employees, the government has recommended a basic hourly wage as the minimum level employees should be paid. Although this minimum is not legally enforceable, a newspaper investigation has revealed that some staff in garden centers in the northern region of the country are paid up to 15% less per hour than the recommended minimum wage. So most of the staff are part-time staff working limited hours each week. So they are paid less, 15% less. The manager of the Kingdom's Northern Region Centers, when asked to comment, stated that Kingdom had obligations to its shareholders to control staff cost. Lower pay levels were necessary to differentiate between staff. So they are saying it is necessary to differentiate between staff, ensuring that managers and staff with experience and expertise were properly rewarded. The manager commented that pay levels also reflected the lower commitment to Kingdom, which part-time staff made compared with full-time. When compared with full-time staff, if you see, this is a broad question on ethics. You will be asked a question on ethics in your section A, 50 marks question. So you have to be prepared for an ethical question. This is based on your ethics. So starting with your report, first I'm going to find the cost of capital before the new bond is issued. Right? For cost of capital, what I have to find? I have to know the market value of equity. I have to know the market value of debt. I have to know the cost of equity. I have to know the cost of debt. Directly without I'm going to the report, I'm going to the appendix. Okay, appendix 1, cost of equity. Okay, so cost of equity I can directly find out, but for cost of debt I need to work out the market value of the bond. So cost of equity is 0.9, risk premium was 9% and risk free was 4% and cost of equity was 0.9 for the garden. Is it so? Here it will be down here. Yes, this one, this 0.9 equity beta for existing garden center, right? So that it will be 0.9. So that cost of equity into risk premium plus risk free rate is this. Now you need the value of equity. Share price into number of shares, 25 million shares. Okay, this is this. Now you have to find the market value of debt. That means market value of bond. So you have to value the bond, existing bond. It was 0.45 into 104. Right? We'll go to the bond and see. It was this 0.45 into 104. Which is 46.8. Okay. Usually we divide it by 100, but here why we are not dividing it by 100? Okay. Okay, so you just multiply it, sorry. You multiply it by 104 and you are getting this. Next, you have to find the WACC, right? So cost of equity into market value of equity coming to cost of debt. It was given as 4.1% into the market value of debt over debt plus equity. This one, 4.1% was the cost of debt, right here. This 4.1% you're taking as cost of debt. Now, so you have got the correct WACC. Now you have to find the estimate of the cost of the new bond. So how are you going to get the cost? Cost means what? Let's go to the second requirement. You're done with the first requirement. Going to the second requirement, market value and yield to maturity of the new bond. You have to find the market value and the yield to maturity. Yield to maturity you have to use IRR. First, we have to find the market value of the new bond, because without that you cannot find yield to maturity. So this is the way, standard way, fixed way of finding the market value of the new bond. Okay. So you have to start with the government annual yield curve. This has already been given to you, and the credit spread. And you add your government annual yield with the credit spread, and you are getting this annual yield curve. Okay, how do you get the basis point? This you have to add. First year 56, 78 like that. 56 basis point means 0.56. You have to add with 4%. So you add your credit spread with this, and you're getting yield curve. Now, value of the new bond based on annual yield curve. So now you have to find the present value, right? What is the coupon rate for the new bond? It was 7.5%. So that's why it is 7.5 into this new rate. You have to use all these rates now for to find the present value. Again 7.5. Third year also 7.5. This is redeemable in 4 years time. In the fourth year, it is 7.5 plus 100. So 100, 7.5 plus 8. That's why it is 115.5. Why it is 8? Because this 8 is the premium. Okay, let me take you. They have told that 8% is the premium. You have to add premium for the new bond. This premium of 8%. That's why you are adding it. And then once you find the market value of new bond, this has to be multiplied by 0.6 million. You are taking this much of bond. So the total price is this. Now, next is yield to maturity of the new bond. This is a standard way, fixed way of finding the yield to maturity. It is there in your textbook also if you have found out. So yield to maturity, you're starting with year 0. Then for how many years? It is 1 to 4. The interest and the redemption value. So you're starting with the market value always. Then the interest. What is the interest you are paying? Post tax, after tax. What is the interest you are paying? 5.63. And redemption is 108. How is it 108? Because it is 100 plus that premium. You're not including that 7.5 interest in the fourth year. Only the capital value 100 plus that 8, the premium. So it's 108. And interest post tax, after tax you have to take. So interest is how much? 7.5, right? interest is 7.5. You are taking after tax. What is the tax? Let's go and take the tax rate. Tax is 25%. So you have to take 25% of into 1 minus, sorry, let me write it here. Into 1 minus 25, which is 5.625. So you're rounding off to 5.63, or you can take it as 5.625 also. So that is your interest. Now 5%, that is your first discount factor. Because what are you doing? Yield to maturity means what? You are using IRR only. If you see, internal rate of return, to find your YTM, yield to maturity. So how do you know it is 5%? The reason you know it is a less figure, see, with 7.5%, okay, wait, no, there has to be rate 5%. Wait a minute. Yes. So it is the market risk premium is 9% and risk free rate is 4%. So 9 minus 4, it is 5%. So you're starting with 5% as your discount factor. Okay. So you're starting with 5% and you see that you are getting a negative present value, right? So if you are getting a negative, that means you need a higher than 5% or lower than 5% to make it a positive amount. You need a lower than 5%. You have to reduce your this one to 5%. This can be any number. It could be even 4% also. It could be even 2% also. It is trial and error. You can use any amount. Does not matter. But it has to be less than 5%. That's it. So here they have used 3%. Using 3%, you are getting a positive. So now you just use IRR formula, the interpolation method. So starting with the lower amount, which is 3% plus. This is the fixed formula for IRR. That formula only you have to take. IRR formula only you have to take. Okay. Using 3%, you are getting the lower amount you have to write at top, 6.9. And then it is an addition because negative. Okay. Because when you deduct 6.9 from this, so 6.91 minus 1.08. Minus minus becomes plus. That's why it is an addition here, 6.91 plus 1.08 into the difference 5 and 3%, 2%. So this is your IRR, YTM, yield to maturity, cost of debt. Now, second is also fine. Third appendix, revised cost of equity and WACC. That is your appendix 3. What is the revised cost of equity and WACC? For that you have to find equity beta, asset beta, all those things, all those calculations you have to do. First you have to find cost of equity, of course, and then only you can find WACC. So what is the garden's asset beta? You have to find the asset beta for the garden. You have the equity beta for the garden only. So it was 0.9 into this we have found in appendix 1, market value, equity value, plus this was debt into after tax because tax is 25%. So this is your asset beta. Once you get your asset beta, you have to use it what? Weighted average asset beta. You have been given the asset beta of the garden and what is the other industry? It has been given separately to 0.88. I remember. It was the retail sector. Outdoor retail sector was 0.88. Okay, and you have to use to know the proportion of that outdoor retail sector and the garden. You have to use the book value of non-current asset. What is the book value of non-current asset? It is 150. Out of that 150, 60 you plan to invest in outdoor shop. So 60. So this is how you're going to get the proportion. 60. Damn, I'm not able to write it. Let me write with my mouse. So 60, you are going for investing in outdoor out of 150 non-current asset. That proportion is for retail and the remaining is for the garden. Okay, 40%. 40% is for outdoor. That means 60 is for the garden. Okay. So here if they have taken, okay, that asset beta. So that asset beta into, wait, there is some something is wrong. 150 plus 60. Maybe we misinterpreted. See, if I can make this mistake, you too can make this mistake, right? So let's see. They plan to invest 60 million in non-current for the outdoor. So this 60 has to be added with. Currently, they have non-current assets that has a net book value. So currently, they have a garden which is 150. Out of that garden, they are adding 60, which is outdoor. So that's why that total. Okay, fine. You have to add both, right? So that's why first 150 is for the garden, and this 0.72 is for the garden's asset beta. That's why it is 150 over the total 150 plus 60 from your outdoor retail. Next, this is for your retail sector, outdoor retail sector, 0.88 into the proportion of retail sector 60 only out of this total, which is 0.77. Okay, now you can use, this is the asset beta for the garden asset beta, weighted average. Okay, for both the garden and the retail outs. Now you have to use this to find the equity beta, this 0.77. So this is the value of equity, it will not change because asset beta to value of equity plus, this is your debt, market value of debt, appendix 1, plus this, what is this, 65.952, and this is already after tax and divided by market value of equity, which is 1.24. Using this 1.24 into 9 plus 4, you are getting cost of equity. But first you have to understand what is this 65.952 over here. What is it? That is your new debt. You have to add revised cost of equity. Remember 69.5. This is this market value of your new bond. You have to add 65.952 with your previous debt, previous bond, 46.8. And then you have to take after tax. So same when you're finding back cost of equity into value of equity plus for the old debt, old bond, cost of debt was 4.1% into that debt plus the new. What is the new? You have just use yield to maturity. This 4.7% for the new bond you have to use 4.7% into the market value of new bond divided by equity plus old bond plus new bond 10.4%. You shall be able to calculate if you are given more than one type of debt, like here old bond and new bond and then equity. There are three things. Usually we take equity plus debt. Here there are three things. Now the revised EPS, earnings focus, that is your appendix 4B4. If you see according to requirements only your appendixes are going. So what is the focus statement of profit or loss? After tax earning, before tax earning it was 24 million. After tax into 75, this is after tax. Okay, in zeros you're dropping down the 3 zeros. Additional finance cost. Of course, with your earnings you have to take additional finance cost because of bond and all, you have to pay interest. Okay, that also have to be adjusted for tax. So what is it? You are going to invest 60 million. Okay, so that 60 million only you have to take here. So see, just say 60 million in non-current assets you have to invest. Means you have to take a debt for the 60 million to invest it. So for that you have to pay interest. And that will be at what? Coupon rate. For the new one is 7.5% after tax. Interest is 7.5%, right? And then additional after tax earnings due to new investment. Okay, we'll check. Sorry, so this 60 is not for that. That is for the finance cost. For new investment, you are investing 60 million. It was for tax. The rate is 10% and after tax, so 0.75. You added. Your revised profit after tax earning is 19,125. How much it increased? From 18 to this, the increase is incremental is 1125. Right? We'll check for the 60 million additional finance cost. So they plan to issue another 0.6 million. That means 600,000. Okay. And with what? With the issue of 7.5% bond. So this is the interest. So for that new bond, you have to pay interest. That's why it is here. If you go down, you will see 60 million. Wait a minute, it is 60 million they're saying, but here it was 0.6. Each with a nominal value of 100. Right? So 0.6 into 100. That's why it is 60 million. Okay. So now you are done with all this appendix. Now you have to go and fill up the report. Starting with the introduction report of the board of directors to whom an introduction. So this report indicates the impact of the proposed investment in outdoor shops and consequent increase in debt finance. It also discuss, so consequent increase in debt finance means the bond. You're taking bond, right? New bond and increasing it. So increase in debt finance, the consequence of that, and also investment in outdoor shops. This report indicates this two impact of this proposal. It also discusses the possible reactions of, so possible reactions of equity and bondholders to the proposal. Financial estimates provided in the appendices are used to support the discussion and assumptions underlying the estimates set out below. Okay, cost of capital. Starting with the cost of capital. So there are two impacts in opposite directions on the WACC. Kim's cost of equity has risen significantly. If something is written, write it in the first line. Write according to the significance, importance of a point. It has risen significantly. Cost of equity. We'll check. We have to go to appendix to check it. If you see, their cost of equity was 12.1% here in appendix 1. Where is the revised cost of equity? In appendix 3 was 15.2%. So it increased from 12.1 to 15.2. And WACC, let's look at the WACC. It was 10.1% and it increased to appendix 3, 10.4. It increased but not so much. So that you have to write. Why that increase? Why it increased significantly? You have to write. So basically you are writing a point that it increased, then you are giving a reason also. This should be your approach for report writing. So this is due to, you are saying why increased business risk is one reason. Yes. How can you talk about increased business risk? Refer to beta. Refer to the asset beta when you have to talk about increased risk. Cost of equity increases only when your business risk increases. That business risk is measured by the asset beta. So see who is having the higher asset beta. resulting from the investment in outdoor shops and increased financial risk from additional debt. Yes. When your financial risk increase, you are taking additional debt. So resulting that business risk, how it is increasing? Because you invested in outdoor shops. How can you say outdoor shops? If you want to find out, go to the asset beta of outdoor shops and see. Okay, it is there in your appendix 3. So appendix 3, check out the asset beta of garden. It is 0.72, but it is 0.88 for investment in retail sector. So it is higher. Higher asset beta means higher risk, right? So the increase in the cost of equity has pushed the WACC upwards. Yes, this is your insights. After you saw that cost of equity increased, you are also seeing WACC also increased. WACC also increased. However, higher proportion of debt in the company's finance structure, with debt having a lower cost than equity, have also been tax deductible, moves the WACC downwards. Yes. So you're writing. WACC increased from 10.1 to 10.4, very small amount, but it didn't increase so much the way cost of equity increased. Why? Because you are having a higher debt now, and that debt, debt has an advantage, tax deductible, interest is tax deductible. So because of that benefit is more than the increasing in business risk, cost of equity. That's why that WACC didn't increase so much. So this is what you have to write. Okay, because we know that debt has a lower cost than equity. Okay, debt was having some 4.1% or something, whereas equity is having a much higher overall. So you are giving an overall picture. Overall, however, the WACC has risen. It increased. You can even give figure also that it increased from 10.1 to 10.4%, meaning that increasing cost of equity has had a greater impact. Yes, cost of equity, that increase in cost of equity had a great impact. That's why that WACC increased, right? Otherwise, WACC would have reduced. Now, coming to assumptions. So basically, all these appendices, this 1, 2, 3, you have wrote in your cost of capital what happened, right? You're not. So the appendix should be more, but when you're writing in a report, summarize it and write. You're not writing each and every figure. Asset beta is this, equity is beta is this. You're not writing all these figures in your report. Now you have to write your assumptions and impact on equity and bond. Just see impact on equity holders. Separate paragraph you have with the subheading and bond holders, and then the conclusion. All these are not there in your appendix. It's discussion. It has to be in your report. So coming to assumptions. Assumption will be so many. 10 marks for it. So at least 5 assumptions you can write and explain. So assumptions about the returns from the new investment may depend on how much they can attract customers away from competitors rather than finding a new market niche itself. Competitive reaction may also impact upon returns. Yes, competitor. That return, they told 10% return, right? 10% return on investment. But how can you determine that return? It's an estimate. So whatever is an estimate, put in your assumption. Because this estimate will change based on your competitor's reaction. The return will be higher if competitors are less. If the return will be lower if competitors are high. More customers are not coming to you, they are going to your competitors. The CAPM model used here is assumed to be a good predictor of equity returns, although some published evidence suggests that it may be. So the CAPM model you have used for cost of equity, another assumption. They assume it's a predictable return, but it may not be. Third, the asset beta. So asset beta is your third assumption. For the outdoor shop is a representative beta. So whenever you use a proxy companies to find your asset beta, that is another assumption. For outdoor shop is a representative beta for similar companies and may not be accurate for this one. Yes, it may not be accurate. Similar companies, because their company financial structure might be different to yours. Okay. So the asset beta use. So if you see this paragraph, the whole thing they are talking about asset beta, asset beta, asset beta. One point in one paragraph only. That's a key. So the asset beta used to calculate the revised, of course, you use the asset beta to calculate the revised cost of equity, is the weighted average of asset betas of the two business. You used it as a weighted average of the asset betas of the two companies. That is also is an assumption. The weighting used in the non-current assets in each business, which is assumed to be proximate to the size of each business unit. This they themselves has given the weighting part. They themselves has given in the case study that this is a good representative for their proportion and all. This is also an assumption. Some assumption they will not give in your case study. You have to write it. Some they will give you, that also you can write it, like the waiting part. So this assumes that non-current assets currently held are valued fairly, right? We assume the non-current assets are fairly valued and their valuation represents the income generating potential and proportion of business rate that each business represents. Coming to the fourth, the share price and the price of the existing bonds are assumed to remain unchanged, right? We assume the share price will not change. That's why market value of equity remain the same with the new bond and after the bond, because we assume it will remain unchanged when the new investment is made. As discussed below, there's a strong possibility of changes in the shareholder base leading to changes in share price and hence in the cost of capital. Yes, if the shareholder base changes, share price will change, hence cost of capital will change. There's a strong possibility of this happening. Now coming to the reaction of the equity holders of this proposal, we'll see. It does not look a good proposal because it increases your cost of equity also, it increases your WACC also. So for me, from equity holders, this will not be a good thing. They anyway don't want their cost of equity to increase. Okay, so the equity holders may consider the returns from the new investment to insufficient. Do you see? Returns from new investment they are considering insufficient. Always the key points. The very significant one which is going to have a very direct impact on the equity holders, you are writing it as first, second, third sentences. This is the way you have to come up with answers. The most important answers, the first, the least answers at the last. You have to prioritize your answers. You cannot write everything. According to the marks only you have to write. Okay, so first one is new investment will be insufficient. Why? The pre-tax return is only 10%. It's lower than the 16% pre-tax return on the existing garden centers and is not much above the 7.5%. Not much above the 7.5% pre-tax finance cost of the bonds used to finance the investment. Right? This was the finance cost of the bond. It's not much. And also it is lower than 16% pre-tax return on the existing garden centers. We'll see for the 16%. Okay. So here if I see, they have already given this. Return on the garden. Okay. Pre-tax rate. Okay. So make sure that you find this pre-tax return on the existing garden centers. Okay, the return you find. Because I'm not going to do it here. Then okay, so now equity holders, now you're going to the second point. Slowly, if you see, first they talked about the returns and all is insufficient and they're comparing. That is your first paragraph, only 3 lines. Coming to the next paragraph. Okay, when you are going from paragraph to paragraph, keep one space. Okay, one line in between. It should not be one line after the other. So the equity holders are likely to concerned about the increases in both business and business. So they are talking about, they are concerned about the business and the financial risk, it increased. Debt increased, financial risk increased, asset beta is higher in investments, in retail, outdoor retail sector, so business risk also increased. So of course equity holders will be concerned. So the increase in business risk is due to higher businesses for the, you're saying why that increase is there, you're explaining, this is called explanation. From here onwards you're explaining, this first line is just explanation, one point. Now you're elaborating on that point, talking about business risk separately, financial risk separately. So the increase in business risk is due to higher business risk of the outdoor shops due to competition in that sector. Yeah, you're saying why there could be higher risk, because competition. Equity holders will be concerned about the possibility variability of returns and also of dividends. Yes, they will be concerned about dividends if there's a higher business risk, as the company is committed to an increased operating cost burden in terms of extra premises and increased finance costs. Yes, they will be worried about dividends because they already have to pay the interest and also the finance for the extra premises and finance cost. Variability of returns may also result in share price becoming more volatile. Share price can become more volatile. All these things, it's not you cannot think of this point immediately, you need time. So you have to think also, there is a time where you have to think, especially for this thing, how to elaborate, what are the extra points I can give. But if you might not be able to think of this point, the last point, let's say, or even the second, you might have stopped after this, still fine, still go ahead with that. Don't try to make it what else I can fill. If you your purpose have to be to finish the paper. You cannot write each and every point the what the examiner has written, because you always have to plan the unexpected things. There will be a time, even if you have planned also, you'll be slow in some area you need to think, so all this time adds up. So just one or two line write each point and just go ahead, keep going ahead. Now the next one, other aspect concerning equity holders might be any restrictive covenant arrest in new bond that affect payment of dividends and also the planned repayment of the bond. So affect payment for the new bond, restrictive covenant of the new bond. Yes, because it can affect the payment also if you have to give everything as an interest only. So Kington already has a significant commitment to repay the 45 million bond in 3 years time, right? Already this is an old bond, already they have a significant commitment to pay that interest. Now the new bond would mean an additional commitment to pay this 60 million just a year later, because it is redeemable for 4 years, that was redeemable for 3 years, that's why a year later 60 million. So the alternative is refinancing, but the terms would be available are currently unknown. The terms are currently unknown, you don't know what are the terms. Now coming to the last one, this risk may mean that the equity holders reconsider the investment. So now they are, this is like a conclusion, summarization, you're summarizing or you are giving a conclusion or recommendation based on what should they do. So they are saying all this risk, financial risk, business risk, restrictive covenant risk, means that the equity holders reconsider, they have to reconsider. You are giving an advice like what they have to do to the equity holders. Their investment in Kingdom, okay? If they are risk averse, what is the meaning of risk averse? They want to avoid risk and they do not feel that additional returns compensate for the risk. They will take into account the return on investment and the new business is lower than the current return on investment in garden centers, although they are not required to make any additional investment themselves for the return on the outdoor shops. The share price will fall if significant number of shareholders decide to sell their shares. So although they may attract a new client of shareholders who are more risk taking, you are basically talking about the attitude of the risk of the shareholders, what they want to do based on their attitude. If they are risk seeking, they will go for the risk. If they are not risk averse, they will avoid and they will sell their shares. If they sell their shares, remember it will affect the share price. So that is the last paragraph is talking about. Now coming to the bond holder and then the conclusion. If you see, usually it is like this only. Equity holders, you will have a lots of paragraph, 4-5 points you will have to talk about. But when you come to bond holders, if you just see one paragraph, don't get sad by that. Don't think that I'm writing very less, I'm not able to write. So don't, another mistake don't do is here you are writing 5 points for equity holders, don't try to write here also 5 points for bond holders. You will never get equal points for each. For some it might be only 1 point, one paragraph only. For some you have to write 5 paragraphs. Depending on the nature, equity holders, they will be concerned about many risks, financial risk, business risk, covenant risk, share price, all those things. But bond holders, they will only be concerned about their bond, their payment, that's it. They're not in the business. Shareholders are the owner of the business, they have to think about so many other aspects. So when you're talking, when you're writing for equity holders in any question, you will always be writing more there versus bond holders or other stakeholders. That's why bondholder is just one paragraph. So bondholders are likely to be concerned about what? Basically, you're talking about each stakeholder's concern point. They will be concerned about the ability to meet its interest and repayment commitments. That's it. Holders of the new bond are particularly likely to be concerned about the ability to repay their capital given the commitment to repay existing bondholders. Yes, for the new bond, they will be more serious because they have to see the commitment to repay the existing bondholders. Now they have to pay for the new holders also. So bondholders may also be concerned about whether financing of the investment allows Kingdom to take undue risk. They may wonder about the motivation for undertaking the new investment. They may also wonder motivation. All this point, especially this points when might not come. You might not be able to write it because you cannot think of this point. Still okay. You can even stop at this point, undue risk, and go to your conclusion. That is my advice. But if you can think more broad points, okay, you can think of points from various angles. That's a very good skill of a candidate, I would say. But if you cannot, most of you, they might not be able to because you're very limited to your thinking and the answers you write. It's okay, don't worry. You might not come up with this point motivation for their investment and all this. Still fine. Go with your conclusion and finish it. So this may wonder about the motivation for undertaking the new investment using debt finance, particularly if they are not convinced about his business case. Okay, of course. Because for bondholders, you have to show your business case. You have to convince that how suitable your investment in a project is. That's why you're taking a bond. If the bondholders are satisfied, they think, okay, it is feasible, your case study or your case plan, it is worth investing on it, then only they will give you the bond. Otherwise, they will not give you a loan or a bond or anything. So they will also see that motivation. Now coming to the conclusion. 4 lines only, very small. Keep it very brief to the point. That's it. Summarizing everything. That's it. Overall, you're giving an action plan. Also, what they have to do. So, assuming a strong business case can be made for the investment and estimates are robust. You are assuming here that business case is also strong. Estimates are also correct. Kingdom may be able to justify financing it solely by debt. They will be able to justify financing it solely by debt and claim that the increase in financial risk is within acceptable level. Yes. However, before committing a further debt, they may also provide a clear plan for repayment of both. They have to provide a clear plan for both current and new bond before going for the further debt, or offer sufficient assurance that it will be able to refinance its debt when it's due for repayment. They have to offer sufficient assurance whether it is due when it's due for repayment. I told you, bondholders will not give you. They will just not give you bond. You need to convince them. Okay. So we are done with the report. Now we can go to section A of the report. It's not a report, sorry, section A of the requirement, and it asked about what? It asked about feasibility and effectiveness of the defense strategy of selling of. So one of the defense strategy is selling of individual garden, that is crown jewel. You're selling a valuable asset. The other one is you are enhancing director's remuneration. You have to pay a very high remuneration to the director. So whether is it feasible to do that or is it effective? You have to tell now. Let's see how the answer is. It is in, okay. So it is in two different subheadings. One is sell of garden center and house directors remuneration contract. So don't try to put it in one. Both are two separate things asked in one requirement. Requirement is one, but there are two sub requirements in that one requirement. So sell of the garden centers. Now we are going to talk about the garden centers, crown jewel. So selling some of the most desirable garden centers known as selling the crown jewels. May deter some acquirers looking to buy the whole chain if they sell the assets they most desire. If you're selling the, see, a company might want to take you over maybe because of that one asset which is so valuable. If you're selling that asset only, they will not have any motivation or any intention to take you over because that asset only is sold. So Kingdom could take this option if it is available to sell of individual centers with a jeopardizing its overall existence. Yes, they could take this option. I have told you always write in probability, could, maybe, would, perhaps. In this scenario, this is most likable, suitable, like this. So they're saying they could take this option. What option? Selling of individual current garden centers. If selling garden centers will not have any impact on their existence, if they can continue with the other paths, what is remaining? If it is so, then only they can sell. Otherwise, we'll see what happens if it's otherwise. So, however, in second paragraph, if no particular use is made of the cash raised from the sale, of course, when you're selling, you are going to get cash. So if you're not using that cash, utilizing, then what happens? Kingdom would still remain a tempting takeover target due to its cash surpluses. Exactly. If you have sell your garden assets and you have huge amount of cash, again you will be a target for a takeover. Why? Because you have huge cash surpluses. That's why you have to use that cash somewhere. You cannot keep it in hand. When you're selling your assets, valuable assets, garden center, you have, once you get the cash in hand, you have to utilize it somewhere. You have to invest in non-current assets, or you might do some reconstruction or increase your debt or something you have to do. But you cannot keep it in hand. Otherwise, you will again be a target for takeover. Then what's the purpose? Because your whole purpose, you are selling your non-current asset in the first place is for you to defend, so that you don't become a target for the takeover. But if you cannot, then what's the use? So returning the surplus cash to shareholders in a form of one-off dividend might be popular with shareholders, but equally they might be concerned about their future returns given the sale of assets generating significant income. This point from here to here, what does it say? I'm explaining each point. Your job is to write it in your own words. This is how you learn, not copy paste exact words, not memorizing exact word to word. Point here they're saying is, okay, so what happens? One way of utilizing that cash, surplus cash, is you can give a one-off dividend. Because once only you are receiving that cash, right? You are selling only once, you are receiving cash also once. So only one time only you can give that cash. So one-off dividend you are giving to the shareholder. Yes, you are saying shareholders will be happy with this, but on the other hand, they will be sad also. Why? Continuing dividend they will not get because of that income stream which they are going to get from that non-current asset is not there anymore. That asset is sold off, so they'll be concerned for that also. So that concern and that whatever benefit they are going to get, you have to write both. You have to evaluate. This is your evaluation skills. On the other hand, you are saying okay, it is benefit. On the other hand, you are saying it's drawback. It's like you are saying the what are the advantages and disadvantages of having a mobile phone. There are both pros and cons, right, of having a mobile phone and not. So same way, there is a pros and cons of selling that garden for shareholders. Now, shareholders and others interested in their kingdom might also question what future strategies the board had in mind if it did not use this cash surplus for investment. Yes, so shareholders and other interested parties, they will question what are the future strategies. If about future strategies means what are they going to do with that cash surplus? Are they going to invest in non-current assets? Are they going to invest in some other stuff? They'll be concerned. So also if the money was distributed to shareholders, King Team would become a smaller company and perhaps more affordable to some potential acquirers. Yes, they could become more affordable. So now you are going to go for the second one, enhanced directors remuneration contract. You are saying effective and feasibility. Enhanced commitments to the directors would represent increased burden for acquirers. Either the cost of honoring them or the cost and the time involved in terminating the director's employment and compensating them. This burden may deter acquires, particularly if the decision to acquire is marginal. Yes. If you want to acquire a company and if you are saying that director's remuneration you are increasing, then the acquirer will not want to take you over anymore because it's a high cost for them, it's a burden for them. So that is the first paragraph. Second, however, enhancing the commitments to directors could be ineffective. Why? Acquirer could decide to keep the directors on and pay the increased remuneration. Exactly. What if it becomes you are expecting, okay, you will tell them that if you increase the director's remuneration then they will not take you over. But what happens? What if your prediction goes wrong and they actually accept your proposal and they say, okay, we'll keep the directors and we'll pay them increased remuneration? In that condition, you will be taken over. So this is an ineffective. Alternatively, the acquirer may feel that buying out the directors' contracts and compensating them is necessary because that it is prepared to bear. Yes, they may feel that okay, all these costs are necessary, and they are prepared to bear it. So that is the second point. Third paragraph, corporate governance aspects are also important. You're talking about corporate governance as a listed company. Now you're linking this to the case study. Kingdom is a listed company. In the beginning of your line, you see, should have a remuneration committee. Yes, exactly. They should have a remuneration committee made up of non-executive directors who will be reviewing the executive director's remuneration packages. Kingdom may have to publish a remuneration report to explain the rationale for directors' remuneration and allow shareholders to discuss and perhaps vote on the report. So all these are the process of having directors, executive directors, non-executive directors, what they are supposed to do, how a director's remuneration is supposed to be set and disclosed. Fourth, shareholders may believe that directors are being given a better compensation package without having earned it, and for no other reason than try to protect their own positions. They may doubt whether directors acting in the best interest of company and its shareholders. Yes, we are saying it is not worth it. It is not feasible to increase their remuneration. Why? The last point is saying that fourth paragraph. Because most of the time it is not earned. You're just giving it to keep them in that place, position. Otherwise, they will leave. Right? It is not something they have earned. It is for their position to protect them so that they stay in that position. You are giving them a higher package. Then a question comes, are they actually acting in the best interest of the shareholders or not? And the company, yes? So now coming to part C. See, the reason why I'm doing all these questions, all these theory questions also I attempt in videos is for you to broaden up your thinking capacity. How far you can think, from which areas you can think. You have to think from a broad angle, different angles, not just one. Okay. So now let's go to part C. What was part C? You have to talk about the issue with the approach and the approach taken for the employee remuneration. Ethics, right? The last paragraph. So what is the approach taken? The stated approach to employee remuneration has some business logic. Expertise. What was that business logic? They are saying that the experienced, more senior should be paid more than the one who is not so experienced and skilled, because they should be able to differentiate the employee. And also part-time should be paid less than the full-time, right? So some logic is there, right? To some point, even you will agree to that point. Why is that? Because expertise, experience, seniority, commitment are all attributes the staff have that could be reflected in extra rewards for them, not only out of fairness to the staff, but also because of their value to the business. Yes, not only that it is fairness, it is also a value. They're giving a value. The more expertise a staff has, the more senior a staff. See, senior and experienced staff will give more value to the company than the one who is you have newly acquired. Right? Everyone agrees to that. So rewarding those people is also fair. Not only fair, it is also they are giving value to the business based on value you're paying. Right? So if staff with these attributes believe they are not being rewarded fairly, they may leave and perhaps join a competitor. That's why you have to give them, because if you, being an ACCA student, if you are given a job which you feel is not according to your qualifications, you are not being paid, you're paid very less, will you not want to join a competitor who will be paying a higher package? Right? So same way for them also. Coming to the second kingdom, now you're linking this to the case study here. Second paragraph, you have to link it like this. So Kingdom company also has a duty to enhance the wealth of its shareholders and has raised expectations by reason increasing dividends. There is a stakeholder conflict as increasing wages of many employees will lead to lower profits and less money available for distribution to shareholders. This is an ethical scenario. You are in an ethical dilemma now. Kingdom, they have a duty towards its shareholders to increase their value, but they also have duty towards its employees. If they pay them more wages, increase wages for all the employees, then the profits for the shareholders will increase, right? The dividends which they give to shareholders will increase, and you are there to take you are as an agent for the shareholder to increase their shareholder wealth, but now your shareholder wealth is decreasing because you are paying higher wages to all the employees. So now what are the issues with this approach? The first issue, one, two, three, four. First issue, okay. the statement about, okay, so the statement about part-time staff, they made a statement. Each statement what they makes, you say it's an issue. So statement about part-time staff not having the same level of commitment may well be unjust. Is it justifiable to say that part-time staff are not committed the same way full-time staff is? No, there are some part-time staff who are very committed. So as they may be as committed as full-time staff during the hours they work. Exactly, maybe they are working less hours, but the hours they work, they are very committed. So you cannot say on the face that they are part-time they will have less committed and full-time will have more. No. Second, the current approach faces a number of ethical issues. What are those? Which may also harm their reputation. So ethics and reputation goes hand in hand. If ethics, you're not ethical, reputation will reduce damage. That's why every company is so concerned about the ethical position and ethical issues and all. That's why this issue has been brought up here. Because King Tim is a big company, listed company, nationwide listed company. So if they don't treat their employee fairly, an employee can go and make a judgment or a statement against the company, against King Tim, which can damage their reputation, right? So it has made commitments to act in accordance with society's expectations and to treat its staff fairly. Yes, in the beginning itself, you read this paragraph, the last, they have told that they made a commitment to treat their staff fairly and society's expectations. Although the basic wage is not legally enforceable, okay, it is not legally enforceable, it does represent society's expectations about what employees should be paid. Yes, that basic wage has to be paid because that is the society's expectation, that at least this much they will be paid, minimum amount. Limiting rewards to staff who may only be able to work part-time because of other commitments could also be something the society judges to be discriminating and maybe against the law. Yes, correct. Just saying that they are part-time, okay, so and reducing their reward is not fair, because this also society sees this as a discrimination for the part-time workers. Coming to the third, in addition, if Kington direct, so issues means problems you are giving, right? All these are problems. In addition, if kingdom directors are given more lucrative contracts as a takeover defense mechanism, this undermines the argument for limiting staff costs in order to maintain shareholder returns. What is it saying? The third point. I'm sure most of you are a little feeling, what is it? What did I just read? So limiting, they are saying if they have a contract, okay, like in takeover defense, what they told that they are going to increase the director's remuneration. If they have the same here for the employee, then they cannot reduce the rewards for the staff. The fourth one, the consequences of this stress to reputation might again be that lower paid staff eventually decide to leave. Yes, lower paid staff will leave. A higher staff turnover mean, so lower staff, there are more lower paid staff in an organization than higher paid staff. The reason is lower paid staff can be, you can give them lower wage, your cost will be down, they will stay, because usually the low paid staff, why they work is because of their survival. They want just a basic job. Even if it's low level, they will work for it no matter what the condition is initially, when their financial condition is not so good, right? So whatever the pay you give, they will stay. So there are more low paid people than higher paid people in an organization. So when this lower paid staff, they start leaving the organization, the staff turnover will be very high. Again, this will be a cost to our reputation, damage to your reputation. So high staff turnover will mean that few staff develop experience and expertise over time. Yes, only few will be there with the organization. So only will develop experience and expertise, which may impact on the customer quality. Yes. See how they are linking from expertise of staff to the customer quality. It will have an impact on the customer quality. Kingdom may also have problems recruiting staff for his new outdoor business. For new outdoor business, you have to recruit staff. Now you will have a problem issue. So customers may also stop shopping at Kingdom in protest of the poor treatment of staff. Customers. See? Customers don't want to shop in Kingdom. because they see that not treating staff poorly. They are not treating their staff fairly. Okay, so all these are issues with the approach. Now we'll see the marking scheme. I think it has not been included here, right? But please just go to the marking scheme and the examiner's comment also about this paper. September, December 2020 paper. And let me know your reviews, how you felt about this paper. Did it make your work much easier? And are my channel, the videos which I make, especially the AFM revision kit solutions and the past paper solution, is it actually helping you to understand something? Do let me know in comments, because I don't get to know from your side how it is. I'm already thinking from my side and assuming yes, you are understanding, it is working and all. But I actually want to know the feedback, your feedback. Because I value it a lot. Right? And I have one mock from BPP which I have to do, and then after that I'm on leave. So if I get comments on a certain paper to do, I will do it. Otherwise, I'm not doing it. Thank you and take care. God bless.